What's up, money lovers? Welcome back. So Disney just had a very strong earnings report. Just listened to the call and got some interesting things I took away from it that I'm going to touch on here, and then we will look at their earnings report, look at some numbers. Disney's a great company that I own. You know, this is just the type of company you buy and hold forever. They've been around almost 100 years now. I think they're 98 years ago, 1923, I think they were founded. And, you know, there were some interesting things said on the earnings call about what the next 100 years of Disney's future looks like. So Disney up around 8% in the after hours on the earnings report. And the stock is actually down, you know, quite a bit here. From the high, it broke $200 and it's all the way down, you know, almost 30% here. So, you know, it's hard to get this company for a really good price, but, you know, you can bet that this company is going to go up over time, obviously. It's interesting that, you know, Disney is up on after their earnings report, while Netflix got utterly destroyed after their recent earnings call. I really didn't think the Netflix report was that bad. So, you know, let me know in the comments below if you want to see a future video breaking down the streaming wars here. Who's going to win out, Disney versus Netflix? Might have to do something like that. But anyway, today we're talking about Disney. So from the call, some of the strengths, I noted that they're talking more about, you know, bringing more general entertainment, bringing it over to Disney Plus just so that they have more content to offer people. That's something that, you know, a lot of people have criticized Disney Plus for, is that there's just not enough there for a wide enough audience. But, you know, it's a relatively new service, and when you take into account they've got Disney Plus, they've got Hulu, ESPN Plus, you know, they bring in a big variety there with sports and stuff like that. And they're working on bringing more content, which is only going to help. You know, it's going to get to the point where there's something for everyone on there. So Disney Plus is only going to continue to grow. And, you know, Disney made a lot of the right moves here that's going to fuel their content ecosystem for the next century. Let's be real. They've got Marvel, they've got Star Wars. These obviously carry huge fan bases, and they've been some of the highest grossing films of all time. They're constantly breaking records, and there's so much more to Disney content. You know, they've got National Geographic, they've got sports with ESPN Plus. There's a lot going on there that I think people don't tend to think about as much. Now, regarding the parks, this is very interesting. So obviously things are starting to look up. 2022 is a little bit better. Restrictions are loosening. We're getting back to somewhat of normalcy. But interestingly enough, Disney is still lacking Walt Disney World visitors. 18 to 22% of the Walt Disney World visitors are international visitors, and that has not come back yet. So the parks are operating at a much better place financially right now than they were a year ago, and, you know, during the peak of the pandemic. Just think about that. 18 to 22% of their visitors are international, and and they have not returned yet. So that's future growth that is baked into Disney. You know, that's obviously going to come back in the next few years. So there will be a 20% boost to their park attendance. They're talking about bringing both higher quality and quantity of, you know, films. The film industry has also obviously been ravaged by the pandemic, and that, you know, led to a lot of delays, but they're starting to pump out these films and, you know, TV series much more often, and that pace is only going to increase, they said. They received a good question. I think this was the best question during the Q&A session on Disney software development. It's historically been a little lackluster. They're not the greatest with the software, you know, so they brought up this good point that that's been a struggle for Disney. How's it going to work as they look to incorporate more things like sports betting? Disney, you may not know, has invested into DraftKings and Fubo TV, interestingly enough. Those are two stocks that when you think it can't get any lower, they just keep going. But if you own DraftKings and Fubo, maybe you're better off just investing in Disney, getting a little exposure to them that way, because they are just, two doozy stocks right there. But anyway, so they said, you know, sports betting and the metaverse comes into the forefront here. How's Disney going to address these technical and software struggles that they've historically faced? You know, Disney responded that this is something that's top of mind for them, and it's actually one of Disney's 3 main pillars of focus. They want to get better and do a better job with the software development. And just think about it. I mean, the metaverse stuff, this mixing of the physical experience with the virtual experience, going to be huge for Disney with all the stuff they're able to offer. So that is definitely going to be highly beneficial to Disney for years to come. And it's interesting, you know, another advantage that you could argue Disney has over Netflix is that they can monetize their content in multiple ways. Netflix is only able to monetize it in one way so far, obviously. Disney obviously they've got the parks, they can sell merchandise. So let's get to the report itself and look at the numbers. CEO said, we've had a very strong start to the fiscal year with a significant rise in EPS, record revenue and operating income in our domestic parks and resorts, significant increase in total subscriptions across our streaming portfolio to 196.4 million. If we compare that to Netflix, they have 222 million total subscribers. It is pretty incredible how quickly they've been able to catch up. I mean, they're on the heels of Netflix here as these streaming wars, or as I like to call it, new cable, heats up. This is a pretty cool statement here. I like this. This marks the final year of the Walt Disney Company's first century. And performance like this, coupled with our unmatched collection of assets and platforms, creative capabilities, and unique place in the culture, gives me great confidence we will continue to define entertainment for the next 100 years. That's quite a statement to make. There's no doubt in my mind that it's true, that they will continue to be at the center of entertainment and our culture for the next 100 years. So, especially with these acquisitions they've made, have just been huge, like Marvel and Star Wars. So their revenue up 34% year over year. Obviously, it could only get better. A year ago, we were still in the midst of this pandemic, so no surprise there to see it increasing, but good to see that they're returning back to somewhat normalcy and a healthy business here. Total operating income was $3.2 billion compared to $1.3 billion last year. Another good sign here in fiscal 2022, our domestic parks and experiences are generally operating without significant mandatory, I don't want to say it because they might flag my video, related capacity restrictions. So hopefully we get to see this revenue just continue to increase. 2022 should be a very strong year, I think, for Disney. Revenue this quarter, you see some healthy increases year over year. Total of $21.8 billion in revenue for this quarter, up from $16 billion last year. And a healthy mix here, between the Disney Media and Entertainment and Distribution segment bringing in $14 billion, the parks bringing in $7 billion, and while that number doubled year over year, that's only going to increase. Like we said, they're still missing that 20% international customer base that has not yet returned. So this was interesting. Their direct-to-consumer revenues for the quarter increased 34% to $4.7 billion, and they did have an operating loss, which increased 27% to $0.6 billion. And the increase in operating loss was due to higher losses at Disney Plus and, to a lesser extent, ESPN Plus, partially offset by improved results at Hulu. So it is interesting to see that segment of the business operating at a loss. It's still early in the game. They're growing. This will definitely be a huge revenue driver for years and years to come, I think, for Disney. It's only going to increase in price, increase in subscribers. They're going to make some serious cash off of Disney Plus. And as I said, they are already increasing the subscription revenue. Higher subscription revenue was due to subscriber growth, as well as an increase in the retail pricing. So as of January 1st, Disney Plus total subscribers, almost 130 billion, up from 95 billion this time last year, 37% increase year over year. So a great growth right there. We'll see if they can keep it up. So while we said earlier, Disney's total subscribers is close to 200 million, but Disney Plus itself is only 130 million. So there should be lots of room left to grow that. And as we said, as they bring more content into the ecosystem, only going to be more appealing to a wider audience. So onto the parks. Disney Parks experiences and products revenue for the quarter increased to $7.2 billion compared to $3.6 billion in the prior year quarter. Obviously, again, this is all related to the vid and the world coming out of it. Interestingly enough, as I mentioned earlier, Disney has invested in DraftKings and Fubo TV. So again, if you are tired of looking at losses in your portfolio on DraftKings and Fubo, look no further. Disney. Look no further. You get some exposure to them by investing in Disney. Disney has something for everyone. Alrighty, guys. So yeah, I don't want to make this one too long. I think that's a great place to wrap up. Let me know what you think of Disney in the comments below. Are you a shareholder? Why not? If you enjoyed the video, don't forget to like, subscribe, drop me a comment below. This is Vinny from the Investment Club, and I'll see you next time.